Have you ever stopped to ponder, what is money? A simple question, yet it has the power to ignite a profound exploration into the veins of our society. It's a concept that we interact with every single day, yet it remains largely shrouded in mystery for many. What is this entity that influences our decisions, shapes our lives, and drives the world? In today's discussion, we will pull back the curtain on this enigma, exploring the intricate web that is money. We will delve into its origins, the nature of its modern form, how it works, and the value it holds. We'll navigate through the seemingly complex labyrinth of currencies, banks, and economies, aiming to demystify the concept that has such a significant impact on our lives. So whether you're a student, a professional, or someone simply curious about the world around you, this conversation is for everyone. Stick around as we dive into the captivating world of money. To understand money, we must first travel back to its origins. Picture a world before coins and banknotes, where goods were exchanged directly for other goods. This was the barter system, our first method of trade, but it had its limitations. For instance, what if you had chickens and needed a pair of shoes? You'd have to find someone who not only had shoes but also needed chickens. This is what we call the double coincidence of wants, and it was a major hurdle in the barter system. So, as societies grew more complex, a need arose for a more efficient system, and thus, money was born. Money served three prime functions. First, it acted as a medium of exchange, making transactions smoother and more straightforward. You didn't have to worry about finding the perfect trade partner anymore. If you had money, you could buy what you needed. Second, money provided a measure of value. Every product or service could be assigned a specific monetary value, making it easier to compare and understand the worth of different items. Third, money served as a store of value. Unlike perishable goods, money wouldn't spoil over time. You could save today's earnings to spend in the future, providing a sense of financial security and paving the way for economic growth. The earliest form of money was commodity money, tangible objects that had value in themselves as well as value in their use as money. Think cattle, grains, or even precious metals. Over time, as trust in governing authorities increased, we moved towards representative money, like gold or silver certificates, which were backed by a commodity. Eventually, we arrived at fiat money, the kind we use today. Fiat money isn't backed by a physical commodity. Instead, its value comes from the trust and confidence we place in the issuer, typically the government. So money was born out of necessity and has evolved over time to become what we know it as today. From chickens to coins, from gold to digital balance, the journey of money is the journey of civilization itself. Money today is not just coins and notes in your pocket. It's an evolving entity, a concept that has grown and adapted with the times. As we advance into the digital age, money has transformed into something much more complex and nuanced than mere physical currency. Let's look at digital money, for instance. It's a form of electronic currency that exists solely in the digital realm. No physical manifestation, no tangible coins or notes, yet it holds real value. Think about your credit cards, online banking, and mobile payment apps. They all represent digital money, enabling transactions without the need for any physical exchange. And then, of course, we have cryptocurrencies, a revolutionary form of digital money that operates independently of a central bank. Cryptocurrencies like Bitcoin, Ethereum, and countless others have taken the world by storm, offering a decentralized, peer-to-peer financial system. They've introduced a whole new dimension to the concept of money, one that's borderless, secure, and to some extent anonymous. But what about the creation of money? How does that work in our modern world? Well, it's not as simple as minting coins or printing notes. Banks and governments play a crucial role in this process. When a bank provides a loan, it essentially creates money. This is because banks work on the principle of fractional reserve banking, where only a fraction of bank deposits are backed by actual cash on hand and are available for withdrawal. Governments, on the other hand, control the supply of money in the economy through monetary policy, influencing interest rates, inflation, and economic growth. They can increase or decrease the amount of money circulating in the economy, affecting everything from the prices of goods and services to employment rates. So, as we can see, modern money is a multifaceted entity. It's physical and virtual, centralized and decentralized. It's created through complex processes and is subject to the influences of various economic factors. Money, in its many forms, continues to facilitate trade and influence our lives. Scene script. Money works as a facilitator, a motivator, and a common denominator. Let's start with money as a facilitator. In the grand scheme of things, money is like a universal language that everyone understands. It eases the exchange of goods and services by providing a common medium. Imagine a world without money. Bartering would be the norm, and it's not hard to see how complex that could get. You'd have to find someone who not only wants what you have, but also has what you want. Money simplifies this process. It allows us to assign a value to goods and services, making trade more efficient and straightforward. Next, we look at money as a motivator. It stimulates work and innovation. It's a reward system that motivates people to put in the effort, to innovate, and to take risks. The prospect of earning money encourages individuals to develop new ideas, start businesses, or invest in others' ventures. It drives economic growth and technological advancement. Without the motivating factor of money, would we have the level of innovation and progress we see today? It's an intriguing question to ponder. Finally, money acts as a common denominator. It provides a standard measure that allows us to compare the value of different goods and services. Whether we're comparing the cost of a loaf of bread to a luxury car or the price of a movie ticket to a concert ticket, money gives us a common scale. It allows us to make informed decisions about how we spend, save, and invest. So, when we say money works, we're not just talking about its ability to buy things. We're talking about its role in facilitating trade, motivating work and innovation, and providing a common measure for value. It's a tool that, when used wisely, can help us achieve our goals and improve our quality of life. Money indeed does work, and it works in ways that impact every aspect of our lives. The value of money is not in the paper or metal it is made of. This may seem counterintuitive, but it's true. Money, whether it's a crisp dollar bill or a shiny quarter, carries value not because of the material it's made of, but because of something far less tangible: trust and acceptance. This leads us to the concept of intrinsic versus perceived value. Intrinsic value refers to the inherent worth of an item, usually dictated by its material composition or practical usefulness. Gold, for instance, has intrinsic value due to its rarity and its applications in various industries. But money, especially the paper or digital kind, doesn't have much intrinsic value. You can't eat a dollar bill or use it to build a house. Its value is perceived, meaning it's based on collective agreement. In other words, a $100 bill is worth $100 because we, as a community or country, agree that it is. We trust that others will accept this piece of paper as payment for goods or services. The government backs this trust, promising to honor the face value of its currency. This trust and acceptance are what give money its value. However, the value of money isn't fixed. It fluctuates based on several factors, including supply and demand, economic stability, and inflation. When there's more money in circulation than there are goods and services available, the value of money decreases. This is known as inflation. Conversely, if there's less money in the economy, its value increases. Economic stability also plays a crucial role. If a country's economy is unstable, its currency's value could plummet as trust in it diminishes. On the other hand, a robust, stable economy can bolster the value of its currency. To sum it up, the value of money is a complex, ever-changing concept. It's not about the paper or the metal, but about the trust, acceptance, and economic factors that surround it. The value of money, in essence, is a reflection of our belief in its worth. So, what have we learned about money? We've journeyed from the birth of money, understanding that it originated as a solution to the barter system's limitations. We discovered that its form has evolved throughout history, from shells and stones to coins and notes, and now to digital representations. We dove into the nature of modern money, realizing that it's largely a matter of trust. We trust that these pieces of paper or digital numbers have value, and that trust is what gives it worth. We explored how money works, how it circulates within an economy, creating a cycle of earning, spending, saving, and investing. We pondered over the value of money, acknowledging that it's not inherent, but rather a reflection of what we, as a society, agree it to be. So next time you hold a coin or note in your hand, remember, it's not just a piece of metal or paper, but a fascinating concept that shapes our world.